I want to tell you about a story that I know of some people that live about 100 kilometers away from me in another town. So it's a husband and wife, and they have two children. And tragically, the husband ended up passing away. Now, the problem with all this is this: they had a house with a mortgage, and they had mortgage insurance on that house. And a lot of you might say, well, okay, that's really great that they had mortgage insurance. That's a good relief because now the insurance on that, because the husband died, is now going to pay for the mortgage on their house. Well, that's not really the case, or it is the case in terms of paying off the mortgage. But what happens is that money comes, the money goes to the bank covers off the debt of what the house mortgage was. So now there's this widow with her two children that doesn't have a job, has her house paid for, but has no income. So the problem is that the house is all paid for, and she has no money to go and buy food because she has no other income. Now, if she wanted to go and remortgage this house, she wouldn't even be able to because she has no job. She has no income. She has no T4 history because she's been home taking care of the kids the last couple of years. So this whole mortgage insurance is ensuring the bank gets their money back, but it's leaving this woman and her children, this widow and her children, in a tough spot. So let's take a look at the difference, because they could have, instead of getting mortgage insurance, they could have gotten life insurance on the husband, the one that was actually making the money. They could have got life insurance on that person instead. So what does that mean? Well, here are the differences between these two things. There is mortgage insurance and portability. So let's talk about that. Then there's also control. Then there's leverage, level coverage. Then there's comfort, and then there's the guaranteed benefits and premiums. On the mortgage insurance side, when you switch mortgage providers from one house to another, you need to reapply for more mortgage insurance, which means that every time you do that, you have to you basically are paying a higher premium because you're older by that time. Because it's a form of life insurance, even though it's only on the mortgage, it doesn't benefit you, it benefits the bank. So your mortgage protection remains the same regardless of if you switch to another house. With a typical mortgage, the lender owns the policy and assigns itself as the beneficiary. So that means the bank owns the policy. You're paying for the policy, but they own the policy and they make themselves the beneficiary. So if you die, they get all the money. Sounds about right? Well, if you are doing life insurance, then you own the policy and you choose the beneficiary and what they can do with that when you die. So in this case of our story, if the husband had life insurance, then the wife would receive all the proceeds of his life insurance. And then she would have hundreds of thousands of dollars, depending on how much his insurance policy was. And she could make the regular mortgage payments on a monthly basis, no problem. And she'd have tons of money to do that. And she'd have tons of money to go and buy food, take care of the kids, and send them to school. And she would have lots of time to sort her life out and get to the point where she's making an income and she is basically making up for the fact that her husband has died. So because you own the policy and you're the beneficiary of it, you can do whatever you want with it. Let's talk about the coverage. As you go through paying your mortgage premiums with mortgage insurance, the premium is staying the same. So the very last month of you paying your mortgage insurance premium, it's the same price that it was at the very beginning. But the amount that you're insured for is a lot less because there's only a small amount left owing on your thing. So the balance of your mortgage decreases over time. How much you get out of the insurance policy decreases over time, but the amount you pay stays the same. Whereas on life insurance, if you are paying this premium, the amount that the benefit is at the very beginning is the exact same that it is at the end. It does not change as your mortgage balance decreases. Now, comfort. This is the problem with some of these mortgage insurance things, is that the underwriting, which is where they evaluate to make sure that you qualify to have the insurance pay for whatever you were insured for, is underwritten at the time of death. So that means that they go and they check all of the things that you said at the beginning. And if you said, oh, well, I have never been screened for cancer, but you had been, got your prostate checked or something like that, that's actually screening for cancer. So if they found any hole in anything at that time when you died, then they would be able to just cancel the insurance and not have to pay for the insurance, the mortgage insurance. So you wouldn't get the benefit of having your mortgage paid off at all. Whereas when you are doing life insurance, they do the underwriting at the time of you writing the policy. So they go and basically lock in everything at that time, not when you die down the road. They lock it in at that time. So that means that it's guaranteed all the way through as long as you pay your premiums. Now, the last thing on guaranteed benefits and premiums is that the mortgage insurances are not guaranteed. They're just not, because of a whole bunch of different factors. Whereas your rates and your guarantees for the life insurance, they are guaranteed. They do stay intact. So mortgage insurance benefits the bank. They get their money back. But life insurance benefits you. And that's the big problem. That's the big difference. That's the big difference. And that's why it is so important to have the right kind of insurance for your needs. In our opinion, mortgage insurance is not the way to go at all. There's no reason to have mortgage insurance when you could get life insurance, which is typically cheaper and can be for a greater amount than the value of your house or the value of your mortgage that you have owing. So it's like a win-win on multiple directions. So that's all I've got for today. Think about that. You can cancel your mortgage insurance at any time and sign up for a life insurance, term life insurance instead. So that might be something worth doing. If you have a mortgage advisor that you're connected with, go and talk to them. If not, let us know and we can recommend somebody to you as well. Cheers.